The nuclear renaissance is here, and it's not just hype anymore. Microsoft is restarting 3 Mile Island. Amazon and Google are signing nuclear power deals. The US just passed the Advance Act, fast-tracking new reactor approvals. Uranium spot prices are holding above $75 per pound, and utilities are scrambling to secure long-term supply contracts because they've been dangerously under-contracted for years. This is the setup of a lifetime for nuclear and uranium stocks. But here's the thing, not all uranium stocks are created equal. Some are royalty plays, giving you pure commodity exposure without operational risk. Others are explorers sitting on world-class Athabasca Basin deposits. Some are already producing uranium right now, generating cash flow. And a few are building the next generation of mines that could be operating by 2028, 2031. Today, I'm breaking down 7 nuclear stocks ranging from $1.66 to $21.76 that cover the entire spectrum, from speculative high-risk, high-reward plays to established producers, from pure uranium exposure to diversified critical minerals companies. Whether you want royalty leverage, development upside, production cash flow, or geographic diversification, these 7 stocks offer different risk-reward profiles for every type of investor. The uranium supercycle is just beginning. Let's find the best way for you to play it. Before I reveal which 7 nuclear stocks represent the best opportunities across the uranium sector right now, and trust me, I'm covering everything from $1.66 microcaps to $21 established names. Welcome back to Smart Investing. I specialize in finding uranium, nuclear energy, and critical mineral stocks with world-class assets, proven management teams, and clear paths to production. If you want comprehensive coverage of the nuclear renaissance, from royalties to producers to developers, you need to hit that like button and subscribe immediately. This is your complete uranium investing guide. Let's dive in. Uranium Royalty Corp, ticker UROY on NASDAQ and URC on TSX, trading at $4.24. This is the world's only pure-play uranium royalty and streaming company. Think Franco-Nevada or Wheaton Precious Metals, but for uranium. UROY provides uranium price exposure without any operational, permitting, or production risk. They invest in royalties on producing and development stage mines, hold equity stakes in uranium companies, and own physical uranium. Crown Jewel, sliding scale net profit royalty on Cigar Lake, world's highest grade operating mine at 17% U3O8. Portfolio includes 18+ uranium interests across Canada, US, Namibia, Australia. Zero debt, 82 million cash. Revenue is lumpy, tied to production milestones in uranium sales, but model provides pure commodity leverage. Royalty model equals zero operational risk, pure uranium price exposure. As mines in portfolio ramp up, Cigar Lake, McLean, and future developers, royalty revenue scales dramatically. Physical uranium holdings, $65 million purchased near $43 per pound, provide additional leverage. In a uranium bull market, royalties can deliver outsized returns without mining headaches. Geographic diversification across 18 assets. Perfect for investors wanting uranium exposure without single mine risk. Energy, Inc., ticker URG on NYSE American and TRG on TSX, trading at $1.66. This is a low-cost U.S. uranium producer operating the Lost Creek ISR mine in Wyoming. Energy uses in-situ recovery mining, the lowest-cost, most environmentally friendly uranium extraction method. Lost Creek has been in commercial production since 2013, currently on care and maintenance, but ready to restart quickly when economics justify. Company also owns the Shirley Basin Project, another ISR amenable Wyoming deposit. All assets in mining-friendly Wyoming jurisdiction. Small cap with significant operational leverage to uranium prices. When prices rise above $60, $65 per pound, Lost Creek economics become very attractive. Management has decades of ISR experience. Pure U.S. production play. ISR mining equals low capex restart. Lost Creek could ramp up quickly, weeks, not years, when uranium prices justify operations. Shirley Basin provides expansion optionality. At $1.66, highly leveraged to uranium price moves, every $10 per pound increase in uranium prices dramatically improves economics. Speculative, but could deliver multi-bagger returns if uranium sustains above $70 per pound and company restarts production. Denison Mines Corporation, ticker DNN on NYSE American and DML on TSX, currently $3.88. This is the owner-owned 95% of Wheeler River project in Saskatchewan's Athabasca Basin, one of the highest-grade undeveloped uranium projects globally. Phoenix deposit holds 109 million pounds indicated at 2.3% grade, 23 times global average. This will be Canada's first in-situ recovery mine in the Athabasca Basin, combining proven ISR technology with world-class grades. Federal permit decision expected early 2026, construction mid-2026, first production mid-2028. Denison also holds 22.5% of McLean Lake JV, started production 2025, 25% of Midwest deposit and other Athabasca assets. $720 million cash position can self-fund $600 million Wheeler River construction. 7 Indigenous community agreements signed. Near-term production catalyst 2028. Wheeler River's 2.3% grades are exceptional, producing 7.7 million pounds annually at $34 per pound all-in costs, creates massive margins at $75 per pound uranium. Federal permit decision early 2026 is major de-risking event. Fully funded construction eliminates dilution risk. Multiple Athabasca assets provide exploration upside. Management has successfully navigated permitting. If uranium prices sustain, Wheeler River becomes a cash machine. Uranium Energy Corp., ticker UEC on NYSE American, trading at $16.34 with $8.4 billion market cap. UEC is America's largest and fastest-growing uranium supplier with 3 hub-and-spoke production platforms. Currently producing at Christensen Ranch, Wyoming, Burke Hollow, Texas, ramping up. Just acquired Rio Tinto's Sweetwater plant and Wyoming assets for $175 million, adding 4.1 million pounds annual capacity. Total U.S. licensed capacity, 12.1 million pounds per year. Launched URNC, United States Uranium Refining and Conversion Corporation, to build America's only uranium conversion facility, vertically integrating from mining through conversion to UF6. Secured 8.8 million pounds in offtake contracts with U.S. utilities. $295 million DFC debt financing commitment, already generating production and revenue. Only company building complete U.S. nuclear fuel cycle, mine, convert, fabricate. Sweetwater acquisition was transformational, bought 4.1 million pounds capacity plus 175 million pounds resources for $175 million. URNC conversion facility addresses critical U.S. supply chain vulnerability, currently zero domestic conversion. Producing now with expansion underway. If uranium prices stay strong, UEC targets $3 to $5 within 2 to 3 years. Energy Fuels Inc., ticker UUUU on NYSE American and TSX, trading at $21.76. This is America's largest conventional uranium producer and a critical rare earth elements company. Owns White Mesa Mill in Utah, only operational conventional uranium mill in U.S., plus multiple uranium mines on standby. Pivoted into rare earth processing, now separating rare earths at White Mesa, targeting production of separated oxides for permanent magnets, defense applications. Strategic because China controls 90% of global REE processing. Energy Fuels provides dual exposure, uranium production when prices justify operations, plus rare earth processing for energy transition, EVs, wind turbines, defense. Also exploring heavy mineral sands, titanium, zirconium. Diversified critical minerals strategy. Unique dual play, uranium plus rare earths. White Mesa Mill is strategic national asset, only U.S. conventional mill. REE processing addresses Chinese dominance in critical minerals. When uranium prices rise, multiple mines can restart quickly. Rare earth revenue provides non-uranium income stream. Diversification reduces single commodity risk. Government likely to support domestic critical minerals production. $21 price reflects diversified asset base. NextGen Energy Ltd., ticker NXE on NYSE and TSX, trading at $11.71 with $8.8 billion market cap. NextGen owns 100% of Rook I project, including Arrow deposit in Saskatchewan's Athabasca Basin, the largest undeveloped high-grade uranium deposit in the world. Arrow holds 340 million pounds indicated plus inferred at 3.28% grade. 2024 feasibility study shows after-tax NPV of $5.1 billion, producing 29 million pounds annually over 23-year mine life at all-in costs of $26.57 per LB. Federal permit decision expected mid-2026. This would be an underground mine using conventional mining methods. Pre-construction complete, engineering advanced. Strong balance sheet with cash to reach production decision. Largest single uranium development project globally. Largest high-grade undeveloped uranium deposit on Earth. Arrow's 340 million pounds at 3.28% grade is world-class. Production of 29 million pounds per year would make NextGen a top 5 global producer. Federal permit mid-2026 is major catalyst. Construction decision could follow quickly. At $11.71, market values Arrow significantly below NPV, potential re-rating upon permit approval. This is the mega project in uranium. Paladin Energy Ltd., ticker PDN on ASX, trading at AUD $12.25, US $7.65 approximate, with AUD 11.5 billion market cap. Paladin is an Australian-based uranium producer operating Langer Heinrich mine in Namibia, 75% ownership. Restarted production March 2024 after being on care and maintenance since 2018, currently ramping towards 6 million pounds annual capacity. In December 2024, completed $789 million acquisition of fission uranium, gaining Patterson Lake South project in Saskatchewan's Athabasca Basin, 93.7 million pounds at 1.41% grade, production targeted 2031. Now a dual asset producer, current cash flow from Langer Heinrich plus future growth from PLS. Secured 12 long-term offtake contracts, dual-listed ASX TSX. Dual asset strategy, producing now at Langer Heinrich, cash flow, while developing PLS, growth. Fission acquisition was strategic, paid $789 million for 93.7 million pounds high-grade Athabasca deposit. Geographical diversification, Namibia, Canada, and Australia exploration. Transformation from single asset to diversified producer. At AUD $12.25, offers exposure to current production and future growth. Q1 FY 2026 produced record 1.07 million pounds despite flooding. There you have it, 7 ways to play the nuclear renaissance, from UROY's royalty model at $4.24 to Energy Fuels' dual uranium rare earth strategy at $21.76. Each offers different risk-reward, URG for speculative leverage, DNN for near-term production, UEC for vertical integration, NXE for the mega project, PDN for current cash flow plus growth. What's your take? Which nuclear stock offers the best opportunity? Royalties, production, development, or diversification? Are we in a multi-year uranium supercycle? Drop your analysis in the comments. If this helped you understand the nuclear sector landscape, smash like and subscribe to Smart Investing. Remember, educational content, not financial advice. DYOR. Thanks for watching.